Hey there, welcome back to my channel. If you ever wondered how exactly the stock market works, you're in the right place. In today's video, we are going to break down the basics and take a deep dive into how the stock market actually functions, how you can make money from it, and why it's one of the most powerful ways to grow your wealth over time. Now, I know the stock market might seem like a mysterious place, filled with charts, numbers, and fast-talking traders, but at its core, it's much simpler than it seems. So let's clear up the confusion and help you understand how you can start investing with confidence. Let's get started. Section 1. What is the stock market? First things first, what exactly is the stock market? Simply put, the stock market is where people buy and sell shares of companies. When you buy a share of a company, you're essentially buying a small piece of that company. It's like becoming a tiny part owner. Companies use the stock market to raise money so they can grow, invest in new projects, hire more employees, and expand their business. Investors, on the other hand, buy these shares with the hope that the company's value will increase and they will be able to sell their shares later at a higher price. There are two main parts of the stock market. The primary market, where companies sell the stocks for the first time. This happens during an IPO or initial public offering. And the secondary market, where existing stocks are traded between buyers and sellers. This is where most of the stock market action happens daily. Section 2. How does the stock market work? The stock market operates in the principle of supply and demand. When people believe a company is doing well and its future prospects look strong, the demand for its stock goes up and the price rises. Conversely, if a company is struggling, people might sell their stocks and the price falls. Stock prices fluctuate constantly because of things like company performance. If a company releases strong earnings reports or launches a new product, stock prices might rise. Economic conditions. A strong economy can push stock prices up, while a recession or economy slowdown can bring them down. Investor sentiment. Sometimes stock market prices move based on how investors feel about a company, the market, or even geopolitical events. Supply and demand. When more people want to buy a stock than sell it, the price goes up. Conversely, when more people want to sell than buy, the price drops. It's not magic, it's economics. Section 3. The role of exchanges. Now, you might be asking, where do these transactions actually happen? This is where stock exchanges come in. Think of an exchange as a marketplace where buyers and sellers come together. The most well-known stock exchanges include the New York Stock Exchange, the Nasdaq, and the London Stock Exchange. When you want to buy or sell a stock, you do it through a broker, and they make the transaction on your behalf by connecting you to the exchange. Exchanges also ensure that trading is done fairly, and they maintain the liquidity necessary for people to buy and sell stocks quickly. Section 4. How stock prices are determined. You've probably seen stock prices change in real time, but how is that price actually determined? It's a constant negotiation between buyer and seller. If someone wants to sell a share of a company, they will set up a price. If someone is willing to pay that price, a transaction occurs. This price is constantly fluctuating based on the bid, the highest price a buyer is willing to pay, and the ask, the lowest price a seller is willing to accept. This is called a bid-ask spread. You can think of the stock price as a reflection of what people think the company is worth right now. But that can change quickly based on new information or shifts in sentiment. Section 5. Why do stocks go up or down? So now we know that stock prices move because of supply and demand. But what exactly causes this movement? The answer lies in a variety of factors, some of which are predictable and others not so much. Company fundamentals. This includes earnings, revenue, growth potential, market share, and more. If a company's fundamentals are strong, the stock price tends to go up. News and announcements. Things like new product launches, acquisitions, or changes can send stock prices up or down. Market trends. The overall direction of the market can affect individual stocks. For example, if tech stocks are trending up, it might lift stocks in the entire tech sector. Global events. Geopolitical issues, natural disasters, and pandemics can create uncertainty and cause stock prices to fall. The volatility you see in the stock market can be a mix of those things, but the market is ultimately driven by human behavior: fear, greed, optimism, and pessimism. Section 6. How to make money in the stock market. There are two primary ways you can make money with stocks. 1. Capital gains. This is when you buy a stock at a low price and sell it at a higher price. For example, if you buy shares of a company at $50 each and sell them later at $100 each, you made $50 per share in profit. And 2. Dividends. Some companies pay out a portion of their profits to shareholders in the form of dividends. These are typically paid once a year, quarterly or every month, and can provide a steady stream of income on top of any potential capital gains. Now, many people confuse the stock market with gambling, but it's actually about making informed decisions, long-term patience and diversification. Don't just buy stocks for the thrill of it. Section 7. The importance of diversification. One of the best ways to minimize risk is by diversifying your portfolio. Instead of putting all your money in one stock, you spread it across different sectors, industries and asset classes. This way, if one company's stock drops, it won't wipe out your entire portfolio. In fact, the stock market overall tends to go up over time, and diversification allows you to benefit from that long-term growth while reducing your risk. And that's a quick breakdown of how the stock market actually works. It's not as complicated as it seems once you understand the basics, and the best part, you don't need to be an expert to get started. If you're ready to start investing, I recommend researching some low-cost index funds or ETFs to begin with. They are a great way to get exposure to the market without taking on too much risk. If this video helped you clear things up, make sure to like, share and subscribe. And leave any questions in the comments, I would be happy to dive deeper into any part of this. Thank you for watching and I will see you in the next video.